I have to say we expected financials to actually outperform last year, and so we were early. I mean, to the extent to which we had been expecting them to outperform for a while, based on the fact that the administration itself wants the velocity of money to increase, and you saw some moves in that direction as far as deregulation, and we'll mention the SIFI designation. The definition was changed there. So to me, this is an important catalyst. But Sarah, you also mentioned rates, and I think that's one of the big headwinds. We're bullish mainly because of the valuations on banks, and we also think that credit standards will ease. By the same token, though, it's hard when you get the yield curve this flat to make a lot of money in banks. So we'll be the first to admit that. And I think stronger economic growth, a steeper curve, would go a long way in helping.
Where are you positioned, big versus small banks, Jason? Because I guess the big guys are still so much bigger, even than this combined entity, that their economies of scale still dwarf any of those regional challenges.
Well, I think the change. I think the change in the SIFI designation led us to believe, and again, we were early on this, but led us to believe that there'd be a lot of larger banks buying smaller and regional banks, and that's still our view. These are kind of merger of equals, so on, something closer to regionals essentially buying each other. In my opinion, not quite. I mean, they're large banks, but in my opinion, there's a lot of smaller banks that would be very attractive targets. And you can see a lot of consolidation.
So, Rick, the theme, in your world today, and in fixed income and foreign exchange, strong dollar, strong bonds, this global growth slowdown trade is back on. And what we're trying to figure out is it just a reversal of the trend we've seen over the last few weeks of January, or is this the start of something new?
No, I think actually it's putting a finer tip on what we already know. Listen, is there a number more important than industrial production in Germany? The manufacturing center of Europe? No, there isn't. And they had their December industrial production number out. Month over month was bad at -0.4, but the year over year, Sarah, was down 3.9. That is the worst year-over-year negative change going all the way back to the credit crisis in '09. We have the Eurozone industrial production numbers out tomorrow, and I don't suspect they're going to be any better. So what's really going on, and I think we even notice it in the U.S., but in a different way, as data comes down the pipeline and we really can pencil in what the markets may have sensed earlier, we just get a better idea of the breadth of the slowing. And I really liked Steve Leisman's intro, and he gave us all the central bank kind of dot plots as to growth, whether the remaining year or for 2020. But one issue he mentioned, that central banks are getting easier, may help. See, in the U.S., it may help because they may have been tightening too much, a little too fast. But outside of the U.S., that isn't the case. They are just adding to a policy that really is hardly reversed, and it's a much different dynamic. The moral of that story is I don't think it's going to have nearly the same positive effect on some of the more structural issues that Europe and many other parts of the globe outside the U.S. have ignored during good times, like more normalization, and it's going to catch up with them. So the only issue I think that's left is trying to calibrate how much of an effect we're going to get from their downturns and potential slipping into recessions, whether it's Germany or other countries within the European group.